Asian financial crisis and financial tsunami.
What are the similarities? This could actually be explained by a vicious cycle. Almost all the crises start with the collapse of bubbles. The Asian financial crisis and the financial tsunami are no exceptions. Bubbles are represented by the balloons, and the investors are the balloon blowers.
Almost all the crises start with the collapse of bubble. The Asian financial crisis and financial tsunami are no exceptions. They share similarities in their causes. The similarities in causes that we found include irrational exuberance, insufficient and inaccurate assessment of risks, as well as insufficient regulation.
Irrational exuberance is what motivates the investors to invest, which is blowing the balloons under the false belief that they could earn a huge profit. When they are overconfident of what they are investing in, they keep blowing the balloon until one point it explodes.
So here comes the question, why would people be so confident in what they're investing in?
Before the Asian financial crisis, returns in industrialized nations were low, so investors looked for investments with higher returns in the Asian countries for the favorable economic conditions. Hence, they invested heavily on Asian stock markets and created a bubble.
As for the financial tsunami, investors held the false belief that housing prices would increase rapidly. For house buyers, they borrow mortgages from the banks to buy properties. Banks then sell the mortgages to financial institutions, who later pack these mortgages into securities and sell it to the investors. This process is what we called securitization. Originally, everyone would be happy as all of them could earn part of the value paid by mortgage borrowers, who was then compensated by the increasing value of their houses. However, what really happened that stopped the cycle is attributed to the emergence of subprime mortgages. Subprime mortgages were mortgages lent to people who were not able to repay. Their resistance undoubtedly heated the asset market since everyone could now buy a house. A huge bubble was formed. Wait, but what's that to do with our story? This is because everyone played a role in the cause of blowing the bubble. Everyone underestimated the risk associated in their investments. In 1997, the optimistic prospect of the Asian economy lured the local enterprises to take on a higher risk in their investments. Due to their close relationships with government officials, owners of large banks and firms had the priority in obtaining low-cost loans offered by central banks, as well as foreign investors. At the same time, since everyone, included themselves, assumed that they would be bailed out by their government cronies, they were more motivated to invest in higher-risk projects for higher return. In other words, they simply didn't have the motivation to assess the risks that they faced. And in case something goes wrong, they would very likely not be able to repay their loans by themselves. Their enthusiasm in risk-taking soon spread across the whole Asia. Everyone ended up taking high risk without assessing it properly. For the financial tsunami, things are a bit more complicated. Everyone overlooked the risk due to different reasons. Homeowners simply paid their installment for houses. Seeing the soaring house prices, they didn't find any risk behind the bubble. Banks serve as an intermediary rather than lender in the transactions of mortgages. The arbitrage between mortgage borrowers and mortgage buyers, that is, financial institutions, generates decent profit for banks under high leverage. Financial institutions also found their interest in the arbitrage between original mortgages, mortgage-based securities, and later collateralized debt obligations. Again, they leveraged themselves to gain more. Lastly, the investors thought that they were investing on highly secure financial instruments based on trustable mortgage payment in the near future. The ratings made by agencies were positive. However, the underlying fact was that agencies were paid by the issuers to rate these instruments. Before the bubble burst, everything looks good. That's when the subprime mortgages we just mentioned came into the matter. Since everyone won satisfactory return, more mortgage-based securities was demanded. But banks didn't have that much prime mortgages on hand. Therefore, they issued more and more subprime mortgages. It didn't matter much to the bank because even if the mortgages went wrong, they could take over the house and sell it at a higher price. However, when more and more mortgages went default, supply of houses in the market increases, and the price of housing finally started to decrease. It decreased so badly that even those promptly repaying borrowers stopped paying for their overpriced houses. A domino effect started. Banks, financial institutions, and investors are getting no payment subsequently. And because the prime driving force of the bubble, the increase in housing price declined, the bubble finally burst.
So, did anyone try to stop the investors?
Insufficient regulation means that no one was going to stop the investors from blowing the balloons. Before the Asian financial crisis, IMF reduced regulation to simple reporting mechanism. The financial deregulation exacerbated the existing problems of companies investing in very risky projects as they were no longer required to take careful assessment of risks. As for the financial tsunami, non-existence of rules or the lax enforcement of law lowered the incentive to assess comprehensively, thus lead to excess risky investments under the temptation of high returns. A shadow financial system emerged which caused the stabilization of the financial system.
Despite causes, both crises also shared similarities in consequences. They are credit crisis and banking crisis, and decrease in trade and output. There were two similar vicious cycles in both crises.
Let's first talk about the effect of declining trend of housing stock prices on the crisis. In both crises, there was a substantial fall of house and stock prices. The leveraged investment holders suffered from huge loss and led many of them to bankruptcy. The financial institutions, worried about the money lent out and the commercial papers purchased would become insolvent, so they tightened the borrowing requirement and increased the interest rate. These measures led to the credit crisis as it became difficult for people to borrow loans. But the story had an end. Since banks could not collect back the money lent out, the debts turned bad and became non-performing loans. The liabilities of these leveraged investments were then transferred to the banks. When the banks were highly leveraged and were unable to repay the loans, bank crisis was resulted. For the Asian financial crisis, insolvency of financial institutions under increasing non-performing loans accelerated the inflation of banking crisis bubbles. Foreign investors began to withdraw capital under the realization of the bubbles. Interbank overnight rate was raised to discourage interbank borrowing. This imposed a high borrowing cost for banks which needed debt to finance their operation, forming a credit crisis. Banks encountered bank run and drying up of liquidity, which further aggravated the banking crisis. On the other hand, mortgage-backed securities, MBS, were financial products whose value were directly affected by property prices. Financial institutions which held MBS encountered enormous losses during the financial tsunami. They tried to sell the MBS at fire sales to prevent further losses and get back the money to finance a business operation. But the money received was unable to cover all the losses. Some financial institutions, like Lehman Brothers, ultimately winded up. Due to the insolvency of many financial institutions, investors were discouraged from holding the MBS. Demand for MBS decreased rapidly, so was its price. Irrational exuberance of predicted high growing trend of property prices was then disappeared. The financial institutions tightened the borrowing requirement and increased the interest rate to avoid insolvency of the commercial papers. These measures led to the credit crisis. These constituted more and more non-performing loans, and the accumulation of these loans inflated the banking crisis bubble. The negative effect of financial crisis on the macroeconomy was also neglectable, namely the decrease in output and trade. Economic output is affected by several factors: households' expenditure, companies' investment, government expenditure, and trade. The consumption expenditure is always affected by households' wealth. The stock market collapsed in both crises, and the housing bubble burst in a financial tsunami. Stocks and houses were large parts of households' wealth. That means their wealth shrank significantly. Thus, households' expenditure reduced greatly. As the effect is worldwide, less consumption of households means less demand for imports. Trade decreased as well. Production then declined as a result of decrease in both local and non-local consumption. Unemployment occurred. As all factors affecting the output decreased, output in no doubt contracted. These would affect the government, as the government could collect less tax from companies and individuals, thereby limiting the government expenditure. At the same time, in the Asian financial crisis, governments were required by International Monetary Fund to reduce the expenditure in order to get an aid from it.